See everyone. Okay. No,
All right.
we're ready to go. You want to start it?
Sure. So, good morning. Welcome to the investment meeting of the Teachers Retirement Board for April 5th, 2021. I'll start by calling the roll. John Adler,
Sorry, as I'm mute, I'm here.
Thomas Brown,
Good morning, Patricia. Patricia, I'm sorry, here's a radio in the back. Somebody has a radio on. It's a little
Lori,
distracting.
lower this, it's classroom. Lori, lower your,
Oh, I didn't know it was you. I thought it might have been somebody.
well, I'm assuming it's mine because I can
Okay,
hear her
I'm
teaching.
here. Good morning, Patricia. I'm here.
Those teachers. All right. Good morning. Natalie Green Giles,
Good morning, here.
David Gazansky,
I'm here.
Russell Buckley,
Present.
Deborah Penny,
I'm here. Good morning.
and John Dorser.
Good morning, I'm here.
All right, we have a quorum. I'll turn it over to the chair.
Okay, awesome. Good morning, everyone. So the first thing we have is I guess it's going to be Mike for Passport Funds Performance Review.
Great. Thanks, Deb. Good morning, everyone. I hope you all had a wonderful Easter and Passover holiday. So we'll start off with a recap of the Passport Fund performance for February, and then we'll move ahead and look back at the more recent performance of the markets in March. If you think back to our discussion already a month ago, but looking at what markets did in February, just a quick recap. US equity market was up about 3%, non-US developed markets up over 2%, and EM with a more modest positive return of about 75 basis points. What really stood out in February from our discussion was this continued a relative performance that we saw between value and growth, where value is now outpacing growth over the last few months. So just to put that in perspective, the Russell 1000 value index was up 6% in the month of February, and the Russell 1000 growth index was roughly flat. So we started to see this dynamic adjust, if you will, toward the end of last year. It has persisted. And in particular for February, what also stood out was small caps outperforming large caps, and the same value growth dynamic that we saw in large cap also continued. Small cap value stocks were up over 9% in February, and small cap growth up about 3%. And that certainly showed through in the relative results of the funds and the underlying active managers. You can see on the first page of the report, the diversified equity fund with assets of about $18.4 billion at the end of February returned about 3% for the month, in line with the Russell 3000 index. That also was enough to outpace the hybrid benchmark's return of about 2.8%. Year to date, the fund is also up about 3.2%, and ahead of both the hybrid and the Russell 3000 benchmarks by about 60 and 50 basis points respectively. If you look down below where we break out the underlying composites of the diversified equity fund, you can see what's contributed to the relative results. So while the defensive, for example, did return 2.25% during the month of February and is up about 2.6% in the month, in the year-to-date period through February, that has detracted a bit from the overall absolute return of the diversified equity fund, as has the international equity composite, as international equities have lagged what we've seen here in the US, but really did offset that, if you will, has been the contribution from active management from the US strategies. You can see in the month of February, those strategies having added over 3% relative results, and year to date, again, a pretty strong relative result of 6.5–7%, contributing to the overall fund. The balanced fund had assets of about $560 million at the end of February. You can see that was up about 70 basis points for the month. The international equity fund, like the international equity composite, up about 1.5% for the month, with a 1.6% year-to-date return. That is about 40 basis points behind its benchmark. The sustainable equity fund has added 1.3% during the month of February. Year to date, it's roughly in line with the Russell 1000 Growth Index, its benchmark, which is down about 75 basis points. And then you can see below that the US and non-US index funds. The US equity index up about 3.2% in line with its benchmark for the month of February, and the international equity index up about 1.6%. Some modest tracking relative to its index. Mostly they're attributable to the timing of cash flows. So I'll pause there and see if there's any questions on February. And if there's not, I'll move ahead to March. Okay, and I apologize. The monthly March benchmark report did only go out about 15 or 20 minutes prior to this meeting. So maybe before we look at the numbers there, I'll just frame out, what we've seen so far in terms of the markets, the economy, and what market headlines or how markets are reacting to headlines. So for March, vaccine cases and hospitalizations ended March on the rise in the US, even as some states have lifted restrictions. Case counts also on the rise in Europe, Brazil, and India. I guess what's been offsetting that negative news is certainly the positive news with vaccination momentum in the US. And that's continued to bolster markets, as has the White House late last month unveiling its $2 trillion infrastructure plan. So the continuation of fiscal stimulus expected to contribute to the growth prospects we talked about coming into 2021. Jobs growth also, payroll numbers reported late last week, and March numbers were significantly above consensus expectations. So continued economic recovery appears to also be making its way, not only through the headlines, but also today so far, the market's reaction has been quite positive, with the S&P up over 1% as of a few minutes ago this morning. So continued strong performance for the markets. There's a lot of numbers here on this page in the report. I'll note just very quickly, the 10-year yield, which isn't shown here, has risen to over 1.7%. So even though we did start to see some days where equity markets were perhaps reacting to the quick jump up we've seen in yields, even though yields have been up, equity markets over the last few weeks have been continuing to plug away and have not reacted too negatively to the rise in yields. For the Russell 3000 index in March, you can see up over 3.5%. The international equity markets were also up. We use the international composite benchmark here as a proxy for the overall non-US exposure in the passport funds. That was up 1.4%. If you peel that back, developed markets outside the US were up about 2.3% in March, and emerging markets were actually down 1.5%. You can see also the diversified equity funds hybrid benchmark up about 2.9% during the month. And all of these numbers obviously contributing to the longer term results that you see toward the right. This is an excellent example of how endpoint specific performance is certainly something that could be misleading if taken on its own. You can see the 1 year number for the Russell 3000 index through the end of March up 62.5%. And obviously that does not reflect the starkly negative experience we had last March. So this is the 1 year period beginning April 1st, 2020. And that just goes to show the difference 12 months can make. Beyond the market performance, you can see toward the bottom half of the page, the performance of the underlying strategy for the sustainable fund up 1.1% during March, and then the passport index funds as well. So I'll pause there and see if there's any questions or comments, and if not, we'll move forward. Not hearing any.
I guess not. Okay. All right. Do we have anything else for public agenda? Is that it? Okay. Hearing none. Do I hear a motion to move into executive session? Don't hold
So
your tongue.
moved.
Thank you,
So
Mr.
moved.
Okay,
Second.
thank you, Mr. Adler, and I think John
Second.
Dorset, and thank you, Mr. Dorset. We'll take that as a second. Any discussion? All right, all those in favor, please say aye.
Aye.
Great. Any opposed? Abstentions? Okay, we're moving to executive session. Hold on to your hats.
You can stay right where you are and start executive session.
We are not moving at all. We're staying right here.
Easy
Awesome.
peasy.
Okay, and Liz, we don't have any public, correct?
No.
Okay,
I double checked.
excellent.
Everything is good to go.
Okay, awesome. So because of the nature of this discussion, we wanted to have it in executive session, but we know that we're gonna,
I'm sorry. I just wanted to give you a heads up. I did lock the room, just so you know, so the room is secure and no one can join, okay?
perfect, thank you, thank you. So normally we ask that just trustees speak during executive session, but we're going to suspend the rules, and we just ask that you ask to be recognized by the chair before you say anything, okay? We don't want you getting all wild and crazy. Just kidding. Okay, so the first thing that we're going to do, I guess, Robin, are you leading us in the discussion of the interest rate risk or?
Well, so actually this discussion is really going to be led by Mike Haddad, but to provide a little bit of context, we have been engaged in discussions with BAM for a few months now on the topic of the fixed income composite and how, if at all, the structure of the investment grade fixed income program within the teacher's pension fund should be modified for strategically or maybe for an interim period to in light of what appear to be a period of potentially rising rates and potentially inflationary pressures. And so this discussion is really a summary of the kinds of conversations that Rokatan and BAM has been having, and I'm sure BAM's been having with other consultants as well. We're not bringing a recommendation to the table at this point, but since this is a really important, potentially important discussion and is a little bit complex, we thought that we could maybe start the conversation today, and it is likely going to be continued at a future soon.
Great, thank you. Thank you. Okay, Mike, you ready?
Yes. I don't know, Mike or Matt, do you want me to share the screen? Do we want to just not share the screen? How should we do this going forward?
I'm happy to share my screen if that works, Deb.
Yes, that would be perfect.
Okay,
Thank you.
Okay.
great. I'm gonna pull up the deck now.
So I'll try and provide some entertainment while you're going through it. So just to follow up with Robin on Robin's comments a little bit, we have been concerned about rising rates for quite a while. A handful of discussions with Rokatan on.
I'm sorry, Mike. Liz, would you be able to turn that on for me?
Which document was it?
I was going to share the executive agenda discussion of interest rate risk.
I
Okay.
gave you co-host ability.
Perfect. Thank you.
And so having discussions with Rokatan to how to think about this and what options are available, to the board to mitigate concerns about rising interest rate risk, if any at all. So, we have the blunt tool of the optimizer, which certainly provides quantitative analysis, and it comes out in to the hundreds with decimal point to two figures, and it feels precise, but we have to recognize how imprecise it actually is because it's dependent upon forward-looking assumptions on return, on risk, and correlation, and just based upon those concerns, or just based upon those assumptions, it doesn't lead to a clear-cut answer. So this is both a qualitative and quantitative process we're going through. So you all have heard me talk about interest rates, constantly, and I'm going to continue to do it. And I apologize for running you through this again, but so I've shared a handful of times kind of a bubble chart that tries to show the magnitude of the monetary and fiscal stimulus. I'm sorry, let me back up one more time. Why are we concerned about rising interest rates? Two primary reasons. It's the combination of the monetary and fiscal stimulus that's in place, and it's secondly, the reopening of the economy as the vaccine rollout takes place, and a strong belief that the interest rate policy by the Fed will have to be modified going forward. And we're not going to really get into the big discussion of whether inflation is going to be tame or 70s like, but really that the Fed's policy setting is going to be inappropriate in a relative short period of time, and what that might do to the structured core fixed income part of your portfolio. So let me start on the qualitative part of it. So again, I've showed you that bubble graph that shows the combination of fiscal and monetary stimulus compared to other past crises. Here I'm going to get a little more granular. So this is on the monetary side. On the left-hand side of this slide, you'll see on the left part of the first slide, the blue bars show the rate cuts by developed market central banks. So think the Fed, ECB, Bank of England, and Bank of Japan, in response to the global financial crisis, and how long it took them to get from that aggregate rate of 3.2 to 0.6. As comparison to how quickly it happened with COVID, when very, very, very quickly between the middle of February and the middle of March, all four central banks were down to zero. On the right-hand side is the quantitative easing part of monetary stimulus. So on the left part of that slide, you can see where that red arrow is. You can see the bump up again from the same four central banks in response to the GFC. And then on the right part of that slide, you see how big that increase in fiscal in balance sheet expansion has been in response to COVID. And much, much, much bigger, much, much, much more rapid. So we have at work unprecedented monetary stimulus. Next slide, please. You layer that on top of unprecedented fiscal stimulus. Again, on this slide, the comparison to GFC in the first column, 2009, on the second column, 2020. And then again, it breaks it down by the relative countries. And you can see US has been the leader of this. And in aggregate, it's been 4.8% of GDP of the world, that is. So this is a massive fiscal stimulus going on at the same time of unprecedented monetary stimulus. Next slide, please. And then this is just borrowed from a GSAM slide, just to show it's only Q1 and Q2, but how big the growth, the potential response to growth from these two monetary and fiscal stimuluses. On the left-hand side of the chart on Q1, on the left part of the slide, the dark blue bar is Goldman's forecast for Q1. The light blue bar is the consensus. The orange bar is the Atlanta Fed, which, as a reminder, they have this now NOW GDP forecasting process where they take all current data and they try and forecast GDP based on that. And it's regarded within markets as a real-time GDP forecast that changes with inputs. So that's even low compared to what Goldman is forecasting. The slide on the table on the right shows the same for second quarter. And again, you can see the really big forecast there. So why this massive bump up in growth? Very simply, much of the supply of the service sector of our economy has been shut down due to COVID. Think travel, hospitality, everything that goes along with it. And as the vaccine rollout continues, we're in excess of 100 million Americans vaccinated. Things are opening up. Even in our fair city, we see things opening up. So these things are going to happen. The growth is going to come. The Fed has been very adamant in their statement, and that they are not going to change policy based on forecast. They're going to base it changed on outcomes. And in my humble opinion, the markets are going to move in advance of them. The longer the Fed waits to react, the more the Fed's going to have to do if these growth forecasts are realized. And the back end of the bond market will start moving as it has been, as I'm going to show you in a handful of slides. Next slide, please. So I'm going to walk you through a bunch of historical slides, backward looking, and the format is going to be the same in that the graph on the left side is a 5-year chart. The graph on the right side is a 20-year chart of the title of the graph. So on this slide, these are 30-year yields. Again, on the left, it's a 5-year view. On the right, it's a 20-year view. Just to give a little greater context as to where we are relative to history. So the takeaway on the left-hand side is yields have gone up a lot since the lows of the pandemic. And if you look just at a 5-year view, you kind of say, all right, they're halfway back to where they were before. They've moved a lot. You know, who knows how the pandemic is going to continue, how the reopening is going to continue. The US is ahead of the rest of the world on vaccines, you know, so on and so forth, all the mitigating reasons why yields might go higher. When you take a peek on the right-hand side, you're like, oh boy, we've gone down a lot for a number of many years. And are we on the process of reversing the trend? Again, we don't know. Just want to provide some context and history of where yields are. Next slide, please. So this is the 10-year inflation break even in markets. And very simply, it's the yield on the 10-year note minus the yield on the tips. And this is a market-based inflation's expectations glimpse. When the Fed talks about inflation expectations, there's both market-based, which this is one of those, as well as forecast-based. So this is what the market is forecasting. Again, on the left-hand side, you can see we are above expected inflation where we've been over the last 5 years. And again, if you take a look at a 20-year view on the right, you can see we're approaching where the high we've been over the past 20 years in terms of market-based inflation expectations. And this is really, I think, core to my opinion anyway, that the combination of the market's reading of monetary and fiscal stimulus has led the market to believe we are going to have a pickup in inflation, and that eventually the monetary policy is going to have to adjust to that. Next slide, please. And when we think about the composition of your structured core fixed income portfolio, it's not just treasuries, it's investment grade and mortgages. The returns from the spread product, investment grade and mortgages, is based upon 3 different components. It's the income component, which comes from the coupon on these bonds, and it's also the change in the value of the bonds, and that's driven by 2 different factors. That's the underlying change in the treasury component, that's the interest rate risk, and then there's the credit risk, and that's the spread risk. So what I'm trying to show here is the historical view of investment grade spreads. And as you can see on the left, a dramatic spike up in the beginning of COVID, a rapid decline as the monetary stimulus and many credit support facilities were put in place. And on the last 5 years, we are at or near where we've been, lows in spreads. Similar story on the right-hand side. Again, if you look back over the last 20 years, investment grade spreads of around 91 basis points is at or near the low on spreads that we've had over that time period. Next slide, please. This is spreads of mortgage securities relative to treasuries. Again, on the left-hand side, you can see over the past 5 years, we're at or near the low we've been in mortgages. And on the right-hand side, similar story. So the takeaway is spread product is expensive relative to treasuries going back over a number of years. And then we just wanted to show you a little bit of historical returns. Over the last 3 years, so for 18, 19, and 20, the average annual return of this is not an index, this is your portfolio has been, in fixed income, has been about 7.27%. The index return only through March 23rd, the index return, so your portfolio is not exactly indexed, but it's similar, is down 4.69. So you can see the impact on this part of your portfolio from a change in interest rates. And the question in front of us, the question we're trying to think about is what do we think is the likely path for interest rates going forward? Are we confident enough, or is the probability of a move up versus a probability to move down enough to consider changes to the portfolio? And if so, what might those changes be? So let me hand it over to either Mike or Matt, because they've done some excellent work on modeling some potential changes to your core fixed income portfolio. I'm going to ignore this slide for the time being.
Maybe Matt, our colleague Matt Malari, can talk about what we've done and how this relates to historical work we've done for the Teachers Board on asset allocation.
Sure. Yeah, thanks, Robin, and good morning, everyone. Apologies for the lots of numbers and small text, but yeah, I think we'll move off of this page pretty quickly and really talk about what the different scenario analyses look like. Just to show you what's here, and again, it's a little tight, but hopefully you have it on your own screen and can look at it more closely. But the important thing to note here, thanks, Mike, for zooming in there. What we've done here is we've really looked at different fixed income portfolios, and when I say fixed income, it's the investment grade portion of the portfolio. So there are lots of rows and lots of numbers, but really the most of the portfolios that you see here, the allocations are the same as the current. So things like public equities, real estate, private equity, even high yield and tips and so on and so forth are the same. We're assuming the same allocations as they are today. What's different is the middle of the page there, which is the investment grade portion of the portfolio. Again, that's made up of different maturity treasury bonds, mortgages, and then also investment grade corporate bonds, which is denoted by the credit line item there. And really what we were after with this exercise, given this conversation about inflation and rising rates, is thinking about different investment grade portfolios that had shorter interest rate durations. So essentially having less sensitivity to interest rates. Just to put some numbers around it, and I'm going to peek at my own screen here. The current investment grade portfolio, so this is just for the fixed income portfolio. I'll sort of give you the numbers here and then at the total portfolio level. But your current portfolio has about an 8.5-year duration to interest rates. And again, that's just for the fixed income portion. If you zoom out and think about it at the total portfolio level, because fixed income is only 25% of the portfolio, that interest rate duration number is closer to 2 years. So what we did is in these 4 alternatives, and you'll see these alternatives referenced as we move forward, but these 4 alternatives look at shortening that interest rate duration by anywhere from 1/2 year to 2 years. And naturally they move in half-year increments. So alternative 1 shortens that fixed income duration from 8.5 to 8. Then you go to alternative 2, goes from 8.5 to 7.5, so on and so forth. So the far right portfolio, alternative 4, that has an interest rate duration of about 6.5 years versus, again, the current portfolio has about an 8.5-year duration. So we're just showing you different portfolios that look at what would happen if we shortened duration incrementally across 4 different portfolios. Again, the rest of the portfolio we've left alone. So all your equities, your alternatives, just assume that the current allocation stays in place there. So maybe let's flip ahead to the next page and bring this to life a little bit. And what we've done here, so this is going to tie back in nicely with Mike's comments just a moment ago about thinking about the interest rate environment, what scenarios might happen, what's the probabilities for all those different scenarios. So let me just walk you through the chart here, and we can sort of talk through some of the different scenarios. So if you start on the left-hand side of this chart, we've essentially picked a few different interest rate and spread environments. So the first column there, change in interest rates. So hopefully fairly straightforward. You can look at if rates fall 50 basis points from today, all the way to what if they rise 100 basis points from today's starting point. We do the same things for spreads. So corporate bond spreads, and again, you could see the numbers there, anywhere from rising 100 basis points to somewhere tightening between 25 basis points, or in some cases not changing at all. So really what you should do is you should blend those 2 scenarios together. So I'll just start at the top row. That scenario is interest rates falling 50 basis points, but corporate bond spreads widening out 100 basis points. And if we get that scenario, that row you see across the top there, that's what we expect to happen for those different portfolios. So naturally, if you have a longer duration like you do today, falling interest rates are a good thing. So you see the current policy target has about a 3.6, 3.7% return, which is better than all of the alternatives, which have a shorter duration. Now let's think about the other end of the spectrum, rising rates, which is I think really what we're more concerned with in this environment. What about that last scenario, that very bottom row? Well, that's again, a 100 basis point rise in interest rates and 100 basis points widening of corporate bond spreads. So effectively think about that as a 2% change in interest rates. And naturally, again, your current portfolio would be the most sensitive to interest rates. It would fall the most, so down about 9%. Whereas that far right portfolio, that alternative 4, which has the shortest duration, that would only fall about 8%. So you're talking about 100 basis point difference in total return. And again, this is assuming no other changes to the rest of the portfolio. So we don't make assumptions about equities. We don't make assumptions about private markets and such. We just assume that what happens in interest rates and spreads here is what dictates the outcomes as far as return is concerned for the portfolio.
And Matt, just to clarify, these are returns for the fixed income portfolio alone, correct?
Correct. That's right. That's right.
Thanks.
So again, I think just, I won't run through every scenario and hopefully the color shading makes it obvious, but if you stick with the current portfolio and rates fall, you're going to be happy. And if you stick with the current portfolio and rates rise, you're going to wish you have shortened duration, right? So, this exercise is a little bit of, as Mike pointed out earlier, thinking about, what scenarios are probable. I can tell you that we and many others in this industry for years have said interest rates were going to move higher. And of course, that hasn't happened. Now, maybe today is different. Mike went through the case for why interest rates could move higher, and certainly is intuitive. And I think we would support a lot of what Mike said as far as, fiscal policy, reopening of economies, all of that translating into higher rates. Now, again, I wish we had the crystal ball and we could say definitively that that's what was going to happen. But, as we've seen for many years here, interest rates sometimes go lower than where they are today. So again, what we wanted to do is just paint a few different scenarios. There's a few more pages that follow that I'm not sure we need to go through that, really have the full matrix so you can blend, choose your rate and spread environment and you can see what the outcomes look like. But we thought just, a few of these scenarios here are, perhaps some of the more common scenarios that we're likely to encounter over the coming months and years.
And so just to wrap this up, so the reason we thought that this might be a useful and productive topic to bring to the investment meeting is really we are contemplating, BAM is contemplating modifying the fixed income, investment grade fixed income portfolio within the pension fund to mitigate this risk of rising rates. We're talking about changing credit spreads because that also can affect the return of the portfolio. But the question on the table is, given this unprecedented monetary and fiscal stimulus, given what is expected to be a significant uptick in economic growth over the next year or two, is there some action we should take to mitigate the risk of rising rates? The fixed income program will, by definition, be negatively impacted if rates rise. And there's, unless we decide to go to cash, there's almost nothing we can do about that. But we can lessen the impact of rising rates if we collectively decide to shorten the average duration of this portfolio. And that's something that can be done without changing managers, without changing strategies that the portfolio is invested in. It would simply, not simply, but it would require rebalancing among existing mandates in order to shorten the average duration. And so we wanted to bring this topic up and see if the board had questions, comments, any top aspects of this analysis that you'd like us to explore further.
Okay, so does anyone have any questions for Robin or for Pam or for anyone? There you go. Any crystal balls, anyone? Nope.
Yeah, I have a question. I raised my hand. Sorry, Deb.
Oh, sorry, yeah, can't.
Um,
Yes, John?
So Robin, you said there's nothing that we can do, but if inflation increases, which presumably goes along with, yeah, I think you said that would be one of the drivers, or you or Mike, of potential increases in rates. Couldn't we increase our allocation to tips? And wouldn't that help to, actually increase returns as opposed to mitigate decreasing returns?
Oh, Robin, I think you're on. Were you speaking?
Sorry, I was going to suggest that Mike take the first turn at responding to that.
Thanks, Robin. John, we started the analysis with 3 different possible changes to the core fixed income portfolio. Change the AUM allocation. So currently it's 25. So we thought, okay, if we reduce AUM, where can we put it, and what will that do for us? The second one was to change the weightings of the 3 sleeves, and the third one was about duration. It gets more complicated from an using the optimizer, when you allow other asset classes to fluctuate. And then it calls into question a whole bunch of different correlations, and you can't easily change one correlation without changing a bunch of other correlations. And Rokatan's correlations are 10 years, a 10-year view, and they're meant to be long-term and not short-term. So I don't think Rokatan felt comfortable doing it. I don't think we felt comfortable trying to push them on that. So we held all the other asset classes steady in order to isolate this prospect. But to your specific question on Alec, so in theory, let's say we took 1% out of this portfolio and stuck it in tips. What would we do there? Remember the tips graph that I showed you? Tips have outperformed by a lot, anticipating this rise in inflation. Would we make more? If we did allocate to tips and inflation went to 3%, we would lose less. However, we would actually lose money on tips because real rates are negative. And part of the thesis of rising rates is real rates, which is the yield on the tip, has to go from, I don't know what it is today, negative 35, call it, to something to 0, if not higher. So as real rates go higher, that's the rate that really matters for tips. Tips are going to lose money as well. They're just not going to lose as much money as nominals.
So I guess the short answer is tips are something we could consider. But it's not as easy a solution because of the negative real rates today in the tips market. But if inflation is our primary concern, we may have decide to modestly increase the allocation to tips. We would still suffer losses within the investment grade fixed income portfolio.
I understand. It seems like under all of these scenarios, if rates increase, we lose money, right?
By definition, yeah.
And so I think I'm also hearing that if we increase the allocation to tips, we would lose less money.
Potentially.
If rates increase. Let me put it down. If rates increase, and I don't know if that's, I'm asking a question, I don't know the answer. If rates increase and we increase the allocation to tips, do we lose less money than if we don't increase the allocation to tips?
Potentially, depending on what happens to real rates, but potentially, and that's something we can look at.
I'm saying if rates increase.
Yeah, no, I understand.
That was the question. That was the predicate, if rates increase.
Well, so can I just say one thing?
Sure.
The rates, I can say that's a stupid question, but the rate increases we've been talking about are nominal rates. And now in the tips example, we're talking about real rates, which typically move in the same direction, but not necessarily with the same magnitude as nominal rate increases. So that's what I said. That's why our assumption here in much of this analysis is what could drive nominal rates up. The movement of real rates is a separate but related issue. And we should, and I think you raised a good point, and we can and should talk about it. I'd also like to make a related point, which is similar to what Mike just said, which is if we thought inflation in our strategic outlook, if we collectively thought that inflation was going to rise very significantly, and we might make different choices about overall strategic allocation and allocation to asset classes that more effectively hedge rising inflation rates. We are not doing that in this exercise. This exercise is intended to focus primarily, almost exclusively, on the investment grade fixed income portion of the portfolio. And when we do our next strategic asset allocation, we may choose to make modifications of our target allocations to private markets and to equities, although I will tell you we're pretty constrained because of the current basket clause in making significant changes to those target allocations, even if we want to. But we're happy to look at tips. I think that's an interesting and good point, and something that we had talked about among ourselves and chose not to add that to this discussion, but I do think it's relevant and we should add it going forward. But what we're not proposing is that we consider, well, what should we do differently in real estate, or should we invest more or less in real estate or private equity? We'd like to keep this discussion focused on our bond portfolios and our investment grade bond portfolios, and focused on this risk of rising rates.
Okay, thank you. So let me just ask one more question. So essentially, I mean, we're not going to make a decision today. You said that at the outset, but essentially you're giving the board a number of alternatives here based on what happens to rates and spreads. And I guess my question is, are BAM and Rokaton making a recommendation on one of these alternatives based on what you think, or the market thinks, or the consensus thinks, or the Atlanta Fed thinks, or whatever is going to happen to rates and spreads? Like, again, as a trustee, and maybe the other trustees feel like they can make this decision, but I can't make a decision. I don't feel like I have the ability to make this decision.
So we are not recommending, I can speak for Rokaton, and I think this is true for BAM as well, and Mike can certainly speak more effectively for BAM. We're not making a recommendation at this time. We're raising what we think is an important risk to be considered. And based on your feedback, questions that arise in this and other forums, we could be prepared to make a recommendation, but this is really intended to be illustrative at this point. And I think it's important to say that any recommendation we make would not hinge so much on our certainty of our forecast, but rather on definition of a known risk and our collective desire to manage that risk more closely. So we always consider interest rate risk in our asset allocation process, but because of the unprecedented nature of the environment we're living in today and the impact it might have on our fixed income portfolios, we may choose to manage that risk more closely. And I think it's important to consider any recommendation that we come forward with in that context, rather than we think rates are going to rise by this much in this period of time, because that's certainly unknowable.
So Robin, is this just a wait and see? Is there any kind of a timeline when a decision would have to be made, or?
So Mike, do you have a view on that?
Yeah, there's no timeline specifically, Deborah, but rates have moved a lot from the absolute lows, which was a year ago, and importantly, a lot since the Georgia elections, which then kind of signified the Democrats would have a lot more leeway with fiscal policy, and we've seen it. We saw a $900 billion package in early January, a 1.9 trillion a couple of weeks ago, and now there's a 2 trillion one on the table. That's quote fully paid for, which we can debate. So I wouldn't say there's a timeline, but if we collectively feel the risks are skewed towards doing something, my 2 cents would be to do it sooner rather than later. So thinking, another go at this at the April sim, if not conclusive, then at your May investment meeting. But I think if the rates are going to move, they're going to do it sooner rather than later. I don't think, like the Fed has said, we're going to wait. Remember, the Fed controls both quantitative easing and the policy rate. The market is starting to anticipate the end of quantitative easing, even though the Fed has said they're not going to end it for a considerable period of time. The Fed has said we will do this until there's been, I think the exact words, considerable progress towards our goals of price stability and maximum employment. What do we know about that? That maximum employment is 3.5%, and that's inflation over 2%, so call it 2.25%. We are going to get inflation numbers the next 2 months that are going to jump inflation to over 3%, and that's known in the marketplace, and that's because the calculation of inflation is a year-over-year number, so it's the previous 12 months compounded to derive a year-over-year inflation number. So when you drop out a really low reading, which will drop out over the next 2 months, and assume a trend-like reading, the mechanics of that calculation call for it to go higher. Will the market react to that? I think the Fed is hoping not so. They've laid it out in detail. We can, I can walk you through the calculation. There's nothing mysterious about it. But to get to your question, I think if we're going to get our arms around this, we're better off doing it sooner rather than later. I don't think rates are headed lower meaningfully unless there's a big setback with either the vaccination program or the reopening program. The last thing I wanted to add, so kind of in conjunction with Robin's comments, why we're not here with a recommendation at this point. We don't know where rates are going in the future by definition. It's in the forward space. So it's kind of some combination of the qualitative feel and the probability aspect around it. And while I don't think any of us think we're returning to the old inflation that we had pre-Paul Volcker as a Fed chair that caused the terrible recession in the early 80s. There's very strong disinflationary forces in the economy, and that's the use of technology, that's global use of labor force, and the demographics in our society. So those are the real big forces arguing for inflation not to move meaningfully higher. But then we're talking about 6 and 7% inflation. That's not on the table as a discussion. The discussion is more, will inflation move to 2.5, maybe 3, and stay there for a while? And if so, what this table in front of you is to represent is if we did that and rates did move up by 100 basis points, what losses do we avoid? And we're trying to provide some context around it. We totally are respectful that it's a complicated process to explain to you as well as to put in front of you. And we want to make sure there's plenty of time for questions. And do nothing is an option as well. To what I'm sure John is going to say at some point, we're not market timers. We're not built that way. That's not what we do. We're a long-term pension fund. We ride through bull markets and bear markets. And that's a good counter to doing anything. And another counter would be, let's say we got our arms around making a decision today. We're going to reduce duration by 2 years. What's the process for when we unwind that as well? And that process will be similar to this process. It will be both qualitative and quantitative, and it will require a joint recommendation by both BAM and Rokutan. Let me pause there. I'm talking too much. Apologies.
Okay, any other questions for Mike, Robin, Matt, John?
Just, so I'm not sure what the outcome of the thing about tips was. Is it possible to add to the modeling? We have a 1% range around the 3% allocation to tips. So is it possible to add to the modeling what would happen if we added the 1% within the rebalancing range to tips, or is that not possible?
I think that's within possibility, yes.
Great, thank you.
Good, okay. Anyone else? All right, so thank you, Mike. Thank you, Matt, for showing us that. And Robin, we ready to go on to the next topic? Okay, all right, so the Passport Funds IPS.
I think that topic is Susan's.
It is.
There's Susan.
There I am. I can't, I see Robin, I don't see myself. Well, so in your distribution packet, which was distributed last week and also this morning again, is the latest and greatest IPS version, which should reflect all comments received to date, and both early, in the summer, which we discussed in the fall or the September investment meeting and in subsequent meetings, and also comments received even after that. So it should be have all of the comments that have been received, discussed, and adopted to date, and it should be ready for adoption, with the small caveat that the emerging market screening policy, there's a sort of a hole in Appendix 8 waiting for a board discussion on whether or not their variable funds will adopt an emerging market screen policies, and then that'll have to be analyzed and approved and adopted. If and when that happens, we can just sort of plop, for lack of a better word, plop it into Appendix 8 and have the IPS ready for adoption at a future board meeting. If there are any questions, I'd be happy to take them. But all I see is Robin. I don't see anybody else.
I don't know why you're looking at me all the time. I'll cancel my video.
You're just on the screen, that's all. Maybe I could do switch to gallery view. Oh, there I can see everybody. Okay, there we go. Okay, so that's all she wrote on the IPS, unless there are any questions.
Any questions for Susan on the IPS? Well, look at that, Susan.
Yes, yes. I feel like I'm having a baby. It almost took that long or longer, but anyway.
Wow.
That note, I will go back on mute where I belong.
Okay, so we're done with this item. That's it. Showed us. Okay. Then we are ready for Passport. Look at that. 20 minutes Passport Funds. Discussion of performance scorecard. The scorecard.
This scorecard, okay. If it's okay with everyone, I'm going to start, but Mike Fulvio is really the expert on the details behind the calculation of all of this. So, so let me start by reminding everyone that several meetings ago, I think it was John Adler that requested some type of analysis that would enable the board to better understand performance data that we regularly provide to them, that would provide a structured way of looking at performance data to better understand whether the realized performance was in line with our expectations of that manager. There's a whole deck, and I presume folks have had a chance, hopefully, to take a look at this, so I'm not going to read through it, but a few points that I want to raise. This should be viewed, this tool, which is what it is, it's a tool to take all of the performance data regarding active managers that we provide to the board on a monthly and longer term basis, and look at the data through a lens that enables us to better understand whether the data raises concerns or not. And so this is different than the manager expectations that we might see in a set of active manager guidelines, where, for example, we might say, we expect this manager to outperform by 100 basis points after fees over rolling 5-year periods. That is a specific point expectation. And what we're trying to do here is develop a range of expectations, because what we all know, is that managers over sometimes multi-year periods can underperform their benchmark net of fees. And on the other end, they can sometimes significantly outperform in a way that we think is probably unsustainable. And so we want to set a range of expectations that can be sort of thought of in a way similar to a rebalancing range. There's a mean where we think things should settle out to over multi-year periods, but we understand that because of market environments, specific stock selection decisions, and because of a variety of other market and manager factors, managers can be above the mean of that range and below the mean of that range. And it is when they're outside that range that we want to pay most attention. So I note here at the bottom of this first slide that, again, this tool is not an automatic quantitative trigger that says we have to terminate a manager, or even that we add more capital to a manager's mandate. It's simply a tool for us to better utilize the performance data that we capture. This second important point, again, is that these risk and return expectations are all forward-looking, and we've built them, and we're going to talk a little bit about how we've built them, but we've built them using what we think are reasonable assumptions, some of which looks back at history, some of which doesn't. And so we'll talk about how the expectations are calculated. And then finally, an important point that we'll return to is in the calculation of this range of excess returns, we rely heavily on the fact and the premise that excess risk, or risk relative to a benchmark, tends to be much more persistent and consistent over time than excess returns. And we use that fact to help us calculate what a reasonable range of expectations is. So with that, maybe we can go to the second slide. And we have included a lot of detailed calculations. And I'm not sure who's Liz, are you running the deck on the screen?
I am.
Oh, you are, Mike. Okay, thanks. So anyway, so we're on the next slide, this slide 3. This gives you a high level look at how we calculate the range of expected returns. As I mentioned, we have a lot of detail in the appendix, and we're happy to talk about the detail. But let me just walk you through the 4 steps here. And let me mention that Mike and I don't do all of these calculations independently. We have, as you know, a manager research group that helps us develop expected information ratios. And those information ratios are used throughout different teams at GSAM. So we use it for institutional investors. These are also used for high net worth investors. They're used for other types of investors. So this is a research topic that our manager research group has spent a lot of time on. So we develop an expected information ratio, and information ratio, to remind those of you who aren't that familiar with the term, is just the ratio of expected of return above the benchmark net of fees over the tracking error of the portfolio relative to the benchmark, or which is the way we define excess risk. So it's just a unit of excess return per unit of excess risk. That's all the information ratio is. And it's based on the premise that if you're there should be some sort of linear relationship between the amount of excess return you get and the amount of excess risk you take. Risk should be related to return. So once we develop an expected information ratio, and that's based on the type of asset class the manager's invested in, as well as the type of strategy, whether it's a very concentrated strategy or a very low tracking error strategy. So we develop information ratios based on the asset class and the type of strategy within that asset class. Then we develop an expected tracking error. So that's the denominator of the information ratio. That's the expected risk. And the expected tracking error is just what do we expect the pattern of returns versus the pattern of benchmark returns to be. How much do we expect the manager's return to move around the benchmark? And then this third step is to develop the numerator, which is we calculate a mean net expected excess return. So once we know what the information ratio is, and we have the denominator of the information ratio, we can calculate the numerator of the information ratio, and that's the mean net expected return. And then we calculate the range of expected excess returns around that mean, and we calculate 1 and 2 standard deviation ranges. So really 4 steps, and the most important step is the first step, which is to develop the expected information ratio, because that drives everything else. So if we could go to the next slide. This is a lot of detailed information, and I'm going to skip over it, but happy to go back to it and answer any questions. But it tells you how we take the information ratio and subtract the annual fees that the teachers pay the teachers' passport funds pay to managers. And it does this for each one of the active managers in the passport fund programs. So what you'll see on the next slide is a comparison of the expected mean net excess return and the actual realized excess returns of some of the passport managers. And on this slide, what we see are the actively managed US equity managers, portfolios, I'm sorry. And let me walk you through the first one. So the first one is New South. We note that it's an all cap value portfolio, and its benchmark is the Russell 3000 value. And what you have in the next set of columns are the actual excess return for periods ending December 2020 over 1 year, 3 year, 5 year, and 10 years. And this is the actual net realized experience of the New South portfolio within the passport funds. So you can see that over 1 year, the portfolio outperformed by over 300 basis points. And over the past 5 years, the average annual excess return has actually been negative after fees. It's 50 basis points negative. Now, the mean of the range for New South is 100 basis points. So over long periods of time, we expect the mean of this range to be a net excess return of 100 basis points. And the next set of columns show the tracking error, which show our expected 3 and 5 year tracking errors, which have been actually realized relative to the long-term expectation. So over the past 3 years, the New South portfolio has had a average tracking error of 5.5 percentage points, and it's the same number for 5 years. We actually look over longer periods of time, and we actually think that New South has experienced lower volatility, lower tracking error than we expect it to have over the longer period of time. So our expected long-term tracking error is higher than what we've seen over the past 3 and 5 years. if you look over most of the managers in this slide, you'll see that tracking error for most, realized tracking error for most managers is somewhat below our longer term expectations, because we've been in a period where we think tracking error has been dampened, and we expect it to actually increase over the coming years. Now, let me talk a little bit about the coloring that we use on this slide. So we've shown on this slide the actual excess return, we've shown the expected mean excess return. But the question is, are these numbers good, bad, or indifferent? We certainly like the fact that, for example, let's look at Diamond Hill. The Diamond Hill has done so well over the 1 year, 3 year, and 5 year periods relative to their Russell 1000 value benchmark. But is that within the range of expectations? And what the dark green color for the 1 year number for Diamond Hill tells you is that their actual excess return over the past year is outside of a 2 standard deviation range for that manager. So we actually expect the mean of the range of excess returns for Diamond Hill to be 40 basis points. So over 1 year, they're more than 700 basis points ahead of the benchmark. That is significantly outside of our range. That's 2 standard deviations outside of our range. On the upside, so our participants did well, but it's still outside of the range. The lighter green colors for 3 and 5 year are outside of 1 standard deviation. So we look at both measures, 1 and 2 standard deviation. The only pink color or red color on this slide is with in Cardinal's row. You see that Cardinal is a small cap value manager. They manage again against the Russell 2000 value index. And over 5 years, they've underperformed their benchmark net of fees by 230 basis points. That means that they are below the 1 standard deviation range of expected excess returns. You see more green than red on this page, which is always a good thing. But any color on this page means that the manager's realized excess returns has fallen outside of the range of expectations of those excess returns for that specific manager. And therefore, we think that additional monitoring or due diligence makes sense at this time. So I'm going to stop, take a pause for a moment, and see if there are any questions, comments, if Mike wants to add anything. Any questions from the board?
Guess not.
Okay, all right. We've done the same analysis for, if you go to the next slide, Mike, for the international equity and sustainable equity funds. Again, this is all as of year end 2020. And you can see, again, there's a mixture of green and red highlighted numbers on this slide. You can see that Spruce Grove, MFS, Spruce Grove, and Fidelity, as well as Brown Capital and Bailey Gifford, have outperformed significantly, so significantly that it's outside of our range of expectations. So that's the good news. On the less good news, you can see that Templeton and Acadian have underperformed our range of expectations. So I'm sure this, this is a lot of data, a lot of information, but one of the fundamental questions is, what do you do once you've been able to at least ascertain that a manager is outside of the range of the predefined expectations? And we suggest on slide 7 that if this tool seems appropriate to the board and there aren't significant, any questions or comments about how the tool is organized or calculated, what we would suggest is the next step should be to define how we react to this information. And we've given an example of a process that might be put in place with using this tool. And what we note on slide 7, if you could just go to the next slide, Mike, is that we could provide this information to the board quarterly. We could do it monthly. That seems a little bit too often. Semi-annual might be a little too infrequent. So we've suggested quarterly here, and that managers who have performed outside the 1 standard deviation range of expectations over both 3 and 5 year time periods would be identified using this quarterly tool, and that over the subsequent quarter, the managers who have been identified as outside of that 1 standard deviation range would then receive additional due diligence from TRS staff and Rokatan. And that additional due diligence would be to ascertain whether we can identify any specific causes for that either significant outperformance or underperformance, because we're concerned about realized performance that is very different from what we expected. And realized outperformance, again, always more welcome than realized underperformance, but that could also be a red flag that risk management has changed, the process has changed in some way that makes this a somewhat different product than we had originally agreed to invest in. So we would do additional due diligence. We would provide a report of that due diligence and a recommendation of next steps, if any, for the board's consideration at the next quarterly meeting, and that is the way in which this tool could be used. I would remind everyone that this tool doesn't limit us taking action at any time that the board wants to take action. It doesn't limit the other reasons that could cause us to perform additional due diligence. If there's an organizational change, ownership change, people coming or going, we could certainly take steps to provide a recommendation at any time to the board on any manager. But this would be a process that's focused on the active manager's performance scorecard and gives us sort of a time frame to do our work and come back to the board with a recommendation and report. So I will pause here and see if there are any questions, comments, feedback.
It's a win-win situation. We can't lose with this. This is great.
Thank you.
Terrific. Yeah. Thank you, John, for suggesting that we need some kind of a process, and thank you, Robin and Mike and team for creating this.
Yeah.
We like a good scorecard. Any questions for them?
I just have, well, one point which Robin knows, but 2 points really on the suggested process. One is that I thought that we should not say that it should be over both 3 and 5 year time periods, but over 3 or 5 year time periods. In other words, if there's a manager whose performance is outside of expectations for either 3 or 5, such as I think Cardinal was, if we look at the example, or Acadian Emerging Markets. Yeah, so Cardinal's 5 and Acadian is 3. I think that we should say, if you're not the 1 year, because I think that's too soon, but if either 3 or 5, I think we should call for diligence in that case. And then the other point I just wanted to make, and it sort of follows from the point that Robin made, that the board can take, action anytime it wants. It doesn't need to be pursuant to this process. So I just wondered, and it might not be, but I'm just throwing it out there. The last sentence where it says managers will not receive additional due diligence as part of the scorecard process for at least 4 additional quarters. Will not is a very definitive statement, like never, ever. And I just wondered whether we might want to just qualify that in some way that says will not receive additional due diligence as part of the scorecard process for at least 4 additional quarters. I don't know what the language would be, something like absent new developments or additional information or something like that. Like, I don't want to, as you said, this doesn't tie the board's hands. That sentence sort of does tie the board's hands, and I almost wonder whether we should just, under normal circumstances, it will not, but for something extraordinary, we might say, please go due diligence again.
I'm fine with that. This is, as I'm sure is obvious to the board, what we're trying to do is, if someone's triggered for the past 3 years, the likelihood is they'll keep triggering for the subsequent 4 quarters because they have to burn off
Right.
the bad performance. And so I just wanted to not have the same managers trigger every quarter, but we can soften this language to make it clear that this doesn't mean we can't do additional due diligence if there are factors or reasons or conditions that make that appropriate. So happy to do that.
Anyone else? Any other questions? Okay, so thank you so much for this.
Great. So can I just say one thing? So I guess one question I had is, this is not going to be part of the IPS. This is just part of, this will be part of our reporting package every quarter. And we'll include this language, I guess, this is really a question on slide 7 as part of the report. Just to remind the board of the purpose and objective of process. Is that fair?
I think that's fair, everyone. Agree? Yep. Okay, I see nods. Okay.
Great, thank you.
All right, great. Okay, and that brings us to manager updates.
There are no manager updates to share with the board at this time.
Wow, okay. And then that brings us to, so then we're ready to go back into public session. Do I hear a motion?
So moved.
Thank you, Mr. Brown. Do I hear a second?
Second.
Thank you, Ms. Giles, Ms. Green Giles.
You can say the talking points came out after we gave them the promotion.
I think, yep, okay, great. What we're up to. Okay, all those in favor, please say aye.
Aye. Aye.
Aye.
And opposed? Okay, we are going into public session, and I'm guessing we don't have to move.
You're good to go.
Okay, welcome back. We're in public session. Susan, would you like to fill us in?
To read out, certainly. In executive session, there was a discussion about the fixed income portfolio and the pension fund. There was a brief update on the progress on the IPS for the variable funds. And there was a discussion of performance data and a tool to analyze this data for active managers within the variable programs.
Thank you, Ms. Stang. Okay, is there anything else that anyone has for public session? Hearing none, do I hear a motion to adjourn?
So moved.
Thank you, Mr. Brown. Do I have a second?
Second.
Thank you, Mr. Adler. Any discussion? All those in favor of adjourning, please say aye.
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 Thank you. Any opposed? Any abstentions? Okay, we stand adjourned. Thank you, everyone. Be well.
Take care. Bye.
See you soon. Bye.
Bye.
Thank you.